Yeah, so good morning. Thank you so much for stopping by for this presentation on collateral choice. A small audience, but I see Albert is here, so very excited. Thank you so much. What's the idea of this paper? So essentially, it's less related to fintech. It more looks at, if you will, a traditional, more microstructure approach. And I want to understand a little bit how financial intermediation is going to impact essentially bond markets in Europe, and what we can learn from that also for example, certain investment strategies. So what do I have in mind in this paper? So essentially, the bottom line of this paper is try to understand how our what I call short-term and long-term funding markets are connected, how that is going to work in Europe, how it's going to be different in the US, and what are some of the lessons we can learn from that. So what do I have in mind when I talk about short-term and long-term funding markets? So I mean, long-term funding markets, it's pretty clear that it's something like issuing some sort of long-term bonds, could be governments, could be corporations that are issuing these securities. Now, the interesting thing is that short-term funding markets do use these long-term bonds, but they use them as collateral to obtain short-term funding. So it's mainly banks who are holding inventories of these bond securities, but they need to finance their inventory. And how do they do so? They access short-term funding markets. They post these securities as collateral to obtain short-term funding markets. So there, by the role of the collateral and bonds serving as collateral in these short-term funding trades, there's an inherent connection between short-term and long-term funding markets. Now, there's also a connection when you think about intermediation from a banking side, if you will. Let's say you're an investor, you're interested in buying some certain government securities for your portfolio because you have some sort of fixed income allocation. You're going to call your bank, and typically the bank is going to cater to your needs. So you can basically buy and sell these securities from your bank's portfolio. Now, what does the bank have to do? Well, like in a traditional microstructure inventory type setting, the bank is going to hold these securities in its portfolio, and it's then going to post them in these short-term funding trades to obtain short-term funding. Now, the main idea now is if there are frictions in these short-term funding markets, which basically lead to additional costs that the bank is going to face, the bank is going to pass on these costs to investors in the bond market, for example, charging higher transaction costs in the underlying bond market. So that's a basic setting here. And what I want to do is look at what are the implications for bond markets in terms of liquidity, in terms of pricing, and what are some of the differences we see in Europe compared to the US, for example. So that's the basic idea here. So just at the beginning, to give you a little bit of the kind of the idea of the setup that I have in mind when I talk about short-term funding markets, just to kind of convey the key message on what are the choices banks are facing. So the main thing to think about is, like, let's think you're a financial institution, you're going to hold this inventory of bonds, and you're going to access short-term funding markets. Now you have two choices essentially to obtain these short-term funding markets. Both are collateralized lending transactions. You're going to post a bond as collateral and you're going to obtain funding, but you can access two market segments. So that's kind of a classification that's broadly the same in Europe and in the US. So the easiest is you're going to access something which is called a general collateral market. So what does it mean? It essentially means I'm going to obtain funding from other banks, but they're okay if I post some sort of security out of a whole basket of securities. So essentially, that's the easiest and convenient way for me. I can just post whatever is eligible to be posted into this basket. Now, there's a second market which is called a specific market. Now, what's the difference? The difference is that the other bank is going to give me the money, but it wants one specific security to be posted as collateral in this transaction. Now, the interesting thing is these transactions actually look rather similar from an economic perspective, but interest rates in these two transactions are actually different. So if I'm a bank, I'm going to post my collateral in a general collateral trade, I actually have to pay a higher interest rate because obviously I do have something what I refer to as collateral choice, but to have that choice, I have to pay higher rates. So if I'm a bank, I'm holding my portfolio of government securities, I should actually try to obtain cheap funding just to optimize my funding costs, which I can pass on to investors. Now, how big is this interest rate difference? Is it small? Is it big? There's actually a paper by Darrell Duffy, which has looked at that. It's this famous repo paper in 1996, where he basically plots the rate difference between the two markets. So he's going to plot, okay, what's the general collateral rate? And then he's going to look at, okay, what is the special interest rate, which is going to be lower? And he looks at one specific security. And that's what he refers to as a newly issued government security, also referred to as on-the-run securities. So there are a lot of investors who want to buy these on-the-run securities for their portfolios. Could be insurance companies, could be pension funds. So there's a lot of demand for these securities, which means that interest rates in that market are pretty low. So if we're going to plot essentially the rate difference between the two markets, we actually see there are very sizable rate differences between the two markets. So you see actually is constantly positive, goes up to 400, 500, 600 basis points. So if I'm going to hold these newly issued on-the-run securities as a bank in my portfolio, I should actually post them in a special segment and benefit from the lower funding cost. So this is basically the starting point of this paper, trying to understand, are banks actually behaving according to what we would expect? Or do we see any differences in the way they choose their collateral in these transactions? And what you see on the upper figure, that's kind of the snapshot of the first results, is essentially, okay, if banks engage in these general collateral trades, what are the actual securities that banks are going to post in that basket? Because that's something we don't really know and haven't seen in the literature. So think about this yellow line as kind of, okay, that's kind of the average of these securities that banks can post, kind of a reference point. Now the orange line, think about something which I call cheapest to post. It's kind of the optimal securities that banks can post to optimize their financing condition. And you actually see this cheapest to post securities is actually more likely to be posted. So that's something we would actually expect banks to do. Now the surprising part is when you look at this blue line here, this is actually these newly issued on-the-run securities. So you would actually get a significant financing benefit of posting them in the special segment, yet you see banks still posting them in a general collateral segment and paying a higher interest rate. So this is quite surprising and something, at least when I started looking into this, wasn't really expecting. And this is actually for Europe. So I'm going to compare that to the US later on, because in the US that's actually different. So this is now what we see in these short-term funding market operations. Now, what can we learn from that in long-term bond market dynamic terms? So what does it translate into in the underlying bond market for the collateral? So the first thing to look at is, okay, what are the actual transaction costs in the bond market? And one proxy would be typical transaction costs like bid-ask spread. And you see actually, okay, it's actually also these on-the-run securities which are requiring higher transaction costs. So if you want to buy as an investor these securities, you actually have to pay higher transaction costs. Actually also different to the US, as I will show later on. And this is interesting because you can also link liquidity in bonds to essentially pricing in bonds. So there's a long literature linking these two. And what you see is essentially, okay, if you're going to have a higher bid-ask spread, tend to have lower liquidity, and lower liquidity is going to translate into higher yields or lower prices. And actually, these newly issued securities in Europe tend to actually have lower prices compared to other securities. And again, this is the very opposite to this on-the-run, off-the-run phenomenon that you see in the US market. And the idea is essentially to link these short-term funding choices to what we are observing in the underlying bond markets and understand why are these things different in Europe compared to the US. So that's in a snapshot the idea of this paper. So essentially 3 research questions. First one is empirically documenting what are the actual collateral choices that banks are making. And the 2 main drivers to think about is something like quantity and price. So quantity is like, think about banks holding portfolios. The bigger the portfolio, the more they need to refinance, also at higher rates. And then think about price or opportunity cost, like how big is the price difference between the two markets. If it's a very tiny price difference, then you might actually be okay just to conveniently put it into a general collateral basket at a higher rate. But if the price difference is very big, I might actually try to optimize my financing decision. Second is then the idea to link that to a bond market with kind of a microstructure inventory type model. Think about this stall type models. It's not really about asymmetric information. It's more about banks holding portfolios of securities. Now they have to finance them. The bigger the cost of finance, the larger the costs are that banks want to pass on to investors. And they do that by charging higher transaction costs in the bond market. And then the last part, again, is an empirical part, just linking that to what we observe from an empirical perspective and compare that to the US market. So that's the basic idea of this paper. Okay, I'm going to skip that just for the settings. So for Europe, I'm using a bit over 10 years of transaction level data on what banks do in these short-term funding market operations to link that to the underlying bond markets. And then for the US, to compare that, I use Fed data to see how banks actually operate in similar transactions in the US and get the idea how the difference is between the US and Europe. Okay, so I'm going to start with some empirical patterns on what we observe in terms of what are banks posting in these baskets and what we can learn from that going forward. So the first thing is, if you have a story in mind that banks are kind of intermediating this market, you can think of, okay, it's not like banks are converting short-term deposits into long-term mortgages, but it's another service. They're essentially subscribing to auctions for investors. They're going to hold them in their portfolio, and then over time, they're going to sell these securities to investors so that investors can have them in their portfolio. So the idea is essentially, okay, investors are not going to participate directly in the auction, but they do so via banks that helps them acquire these securities. So if that's the case, what should we see? Well, we should see something like banks initially subscribe to auctions, have a huge portfolio of these securities, and they need to refinance that portfolio. But over time, as they're selling these securities to investors, they have less of those securities in the inventory, so they actually have to post less of those in these baskets. And that's exactly what you can see. So you see here, shortly after auctions, banks are posting a lot of these securities in these general collateral baskets. Over time, you actually see this is going to go down, indicative of banks selling these securities. But then if they're going to engage in reopenings, again, they deliver more, and it's going to go down over time. So very consistent with this idea, banks are going to subscribe to auctions, and then as long as they have to finance them, they have to also finance portion at the higher interest rate. Now, just to give you an idea of the magnitude, so 0.2 means that on a single day, banks post about 20% of what has been issued in these general collateral baskets. So basically within a week after the auction, the entire issuance amount has been posted once in these funding operations. So there could be a link between these costs in this market and what you see in the bond market. Another way to think about could be, or variation is, okay, what is the central bank going to do? Central banks, for a long period of time, tended to purchase these securities. But the nice thing was that shortly after the auction, there was a blackout period, so they weren't allowed to buy these securities. So essentially, to see another sort of variation, you see, okay, for this blackout period, there's essentially nothing. But after the blackout period, you see that banks are selling not only to investors, but also to central banks. So there's a smaller need to finance, which essentially leads to lower delivery volumes. So this kind of the volume quantity idea of what banks are doing in this market. Another way to think about it would be, okay, what is the actual price difference between these two markets? So think about, okay, there's a very tiny price difference between posting something conveniently in a basket or trying to call other banks to offer me cheap financing rates. If the difference is very small, I might not engage in this optimization. But if the rate gets wider, or the rate difference gets wider and bigger, I might try to exert more effort to optimize my financing decisions. And again, this is something you can see in the data. So if the spread is somewhere around the 5 basis points mark, a lot of these securities are going to be posted in the general collateral basket at the higher rate. So there's no, not so much of an optimization, but as the spread gets wider, you actually see delivery volume significantly going down. So there's an optimization that banks as intermediaries try to do in this market. Interesting thing is, if you look at, let's say, spreads 40, 50 basis points, so quite significant interest rate differences, if conditional on those spreads, bonds are being delivered, those are very likely to be these newly issued on-the-run securities. So it seems to be banks hold those securities. Now, they try to optimize their financing decision, but because they're holding so many, they still have to post them at higher interest rates. That's the main idea of these empirical observations. I'm not going to go into too much detail on the empirical part, but essentially the empirical part is a set of panel regressions to confirm this graphical intuition. The main idea would be delivery volume is going to go up the more of these securities banks hold in their portfolio. Delivery volume is going to go down if the rate difference between the two markets gets wider. But on average, these newly issued securities are most likely to be posted in these general collateral baskets, which is something, again, from like a theoretical perspective, you would ex ante not expect. So the idea is then, okay, if we know these delivery patterns, what can we learn about bond markets? Because that's something investors care about. If we want to buy government securities for our portfolios, what are the transaction costs in that market? What can we learn from that? So the idea is to have a very simple microstructure-based model. So you can think about an inventory type model. So you're going to have your dealer. Your dealer is going to subscribe to auctions, going to build up his portfolio of securities, and he does so to sell them over time to non-participating investors, pension funds, insurance companies, and so on, who would like to hold these securities. He might also keep something in his portfolio, more like a market-making idea, but essentially he's going to hold these securities and he needs to finance those securities. So he's going to access short-term funding markets to actually finance his inventory of securities. But this is going to lead to costs for the dealer. He has to pay interest rate and opportunity cost, and he wants to get compensated for the cost that he's incurring. So what is he going to do? He's going to charge transaction costs in the bond market accordingly, so that if there are frictions in short-term funding operations, higher cost he's incurring, this is going to lead to higher transaction costs that he's going to charge to investors in the bond market. So that's a basic idea. So again, it's not really about asymmetric information about the value of the collateral. It's more about an inventory type idea here. So the main trade-off that the dealer is going to face is, okay, I can post my security at a high interest rate, and I can post it at a low interest rate. Obviously, I'm going to have a financing benefit from accessing the cheap financing. So I'm going to have an incentive to access cheap financing. But at the same time, I'm also going to face search costs, because I have to find other banks who actually want to have this specific security as collateral to offer me the cheap financing. So this inherently trades into, or leads to a trade-off between, okay, I'm going to have financing benefit versus the search cost that I'm facing in the market. So at the end of the day, I'm going to have some sort of optimal share that the dealer is going to post at the cheap rate, and a share that a dealer is going to post at the higher interest rate in the market. And depending on how large are, for example, frictions in the market, how easy it is for me to find a bank to offer me the cheap financing, I'm going to post more or less at the lower interest rate there. And this then basically leads to what are the transaction costs that the dealer is going to charge in the bond market. Very simple kind of stall-based optimization. From an empirical side, what you can actually see is that what dealers are going to charge in transaction costs tomorrow in the bond market actually depends on how they're refinancing themselves today. So essentially, if dealers have a larger share of financing in the market with a higher interest rate, this leads to a higher transaction cost in the bond market tomorrow. And if the rate difference is actually wider, this also leads to an increase in the transaction costs in the underlying bond market. So that's a basic idea here. Okay, so then just very briefly on the last part, now why is this kind of surprising what I told you? And again, this goes back to what we actually know from the literature now from a US perspective. So this was on Europe. The interesting thing is when you look at the US market, things actually look different. So this is a paper by Arvind Krishnamurthy back in 2002, where he essentially documented this so-called on-the-run, off-the-run yield spread in US Treasury market. So what does it mean? It essentially means these newly issued on-the-run securities tend to trade at a higher price and thus a lower yield than their off-the-run counterparties, which are kind of basically similar bonds. So it's quite surprising to see that in the market. And for example, yesterday in the keynote, we heard about long-term capital management. One of the transaction trades they engaged in was so-called conversion trade for on-the-run, off-the-run securities. So they essentially bought or went long the undervalued off-the-run and shorted the on-the-run security. Tiny basis spreads, but once leveraged, yielded a profit until about the Russian crisis when things changed a little bit in the market. But that's a basic idea which we know from the US market. Now, again, you're going to ask, why are these on-the-run securities more expensive in the market? What do investors value? Well, follow-up work has shown that investors actually value liquidity. Now, again, liquidity has various different dimensions, not super easy to grasp, but one way to capture it would be transaction costs in the bond market. And what has actually been shown is that these newly issued securities in the US market are liquid in a sense that they offer the cheapest transaction costs or bid-ask spread. So this is kind of one of the most prominent explanations for this yield benefit. Now, if I'm going to look at the euro setting now, comparing essentially the US and Europe, you actually see the opposite. You actually see that these newly issued securities actually tend to have higher transaction costs. That's something we have seen initially at that figure. So it's quite surprising and the opposite to what you see in the US. And I think these short-term funding market trades actually offer an insight as to why this could be the case. So the basic idea is just to kind of put the key takeaway is that when you think about this financing optimization of dealers, you actually see in Europe, dealers rely a lot on this general collateral financing at higher interest rate, whereas in the US, dealer financing decisions are much more optimized. They're much easier in accessing cheap financing. And this is actually leading to a cost benefit for the dealers that they can pass on to investors in the bond market. Now, why is this the case? Well, it could be, for example, that search frictions are much lower in the US market. Treasuries are much more homogeneous. You don't have different countries. You have just one issuance cycle. So it might be much easier to actually access cheap funding from other dealers who are interested in this market. But that's a basic idea. So it's really kind of trying to understand what can we learn from dealer kind of intermediation funding activity on what we see in kind of bond market dynamics, which are actually different in Europe compared to the US. Thank you.